US Treasury just released a shocking report that they need $1.6 trillion before the end of the year. At least on July 28th, you are looking at, from the Treasury itself, their announcement of marketable borrowing estimates between now and the end of the year. During the July through September quarter, the Treasury expects to borrow $1.007 trillion in privately held net marketable debt, assuming an end of September cash balance of $850 billion. So as of the time of this recording, in less than 2 months' time, the Treasury needs to borrow a full $1 trillion. Now I know what you're thinking, but wait, they're rolling debt over. They're going to use some of that to pay off some of the debt that they owe that needs to be repaid right now. This is just to account for maturing debt. And I know that you probably think that, but the key here is the word net. In other words, there is a lot of debt that's maturing right now that they have to roll over. But this borrowing announcement is talking about the net additional borrowing they have to do on top of all the borrowing that they have to do to pay back all the debt that is coming due. The announcement goes on to detail that in October through December of 2025, the Treasury is going to borrow an additional $590 billion in privately held net marketable debt, assuming an end of December balance of $850 billion. So for the rest of this year, the Treasury is targeting an end of year cash balance of around $850 billion. What does that mean? This is talking about the federal government's checking account called the Treasury General Account. You can see this account currently has a balance of about $421 billion. Whereas usually ever since about 2023, this account is normally hovering around the $800 to $850 billion mark. Now, this is literally just the checking account for the US government. So all tax money and all borrowing money first goes into this account, and then any dollars that they spend go out of this account. And despite the fact that this account used to carry a much smaller balance, for whatever reason now, the Treasury really likes to keep it around $850 billion. But considering this quarter, they are going to borrow an additional $1 trillion, and next quarter they're borrowing $590 billion. That means of the total $1.6 trillion that they're borrowing by the end of the year, only about $400 billion of that is going to refill their checking account. That means $1.2 trillion of that excess borrowing has to be done just to accommodate the spending that is in excess of taxes. As of today, the national debt is $36.99 trillion. And considering that that deficit, the amount that they're borrowing, which is the amount they spend in excess of the taxes, goes directly onto that national debt pile, we can do some really complicated, fancy math to determine what the national debt will be by the end of this year. By taking 36.99 plus 1.6, we can see that by the end of the year, the national debt will be just about $38.6 trillion. Now, I know that many people were expecting the borrowing and the spending to slow down. So how does what's happening right now compare to what's happened over the last couple of years? Well, let's take a look at this chart that tracks the deficit year by year going back to 2020. And you can see very expectedly in 2020, the deficit shot up starting in March. For the next couple of months, added a few $1 trillion. 2021 was very similar, adding more spending in the first half of the fiscal year and less in the second half. 2022, we can see the net borrowing, the deficit went down significantly compared to the prior 2 years. 2023 and 2024 were almost identical, on track with each other in terms of how much net borrowing took place per month for each of those years. And now we come to the current year, 2025, and we can see that so far every single month this fiscal year has been above trend compared to 2024 and 2023, and obviously 2022, except for the most current month reported, which is June. And June came in just barely below the June for 2023, but still above the June for 2025. Now, when those June numbers came out, just as you might expect, there were a lot of people that were saying, hey, this is a sign things are turning in the right direction. The deficit is slowing down. Turns out it was just a timing issue because over the next week, once June ended, the Treasury borrowed about $400 billion in 3 days. And we know this because the Treasury reports what it does down to the day. And you can see that from July 2nd through July 8th, they added about $400 billion to the national debt in net new borrowing. And $400 billion is more than sufficient to put the July numbers back above trend for 2023 and 2024. And just by the end of this quarter, end of September, the deficit will be $1 trillion higher than it is right now, ending at around 2.3 trillion, well above trend from last year and the year before, and getting dangerously near the spending levels we were seeing all the way back in 2021. So unfortunately, for anybody who is hopeful that the spending would slow down, it is not. Now you might be wondering, who are they borrowing from? Where is the appetite coming from for all of this debt? And that's actually a big problem right now. Globally, the government bond liquidity index is at one of the worst places it's been since the data was being tracked, which goes all the way back to the great financial crisis. This tracks government bonds around the world, not just US Treasuries, but you can see a big problem here. The demand, the appetite to lend money to governments when you know you're probably going to be getting a yield that is lower than the rate of inflation over the long term, the appetite is drying up. The liquidity is drying up. And that's why the auctions, especially for the longer term bonds like the 30-year US Treasury, are going poorly, pushing yields up higher. This is why there's so much attention on the Federal Reserve right now, because it's only the entity that can print money into existence that can save the government from their fiscal spiral that they're facing right now. Now, I understand that with everything going on right now, from Trump's tariffs being on one week and off the next, to this massive spiral in increased government spending, to the mounting pressure on the Federal Reserve to drop rates and to put anybody in place there who will do it. You don't need me to tell you that the markets are teetering on the edge of a massive melt up or a massive meltdown. That's why this coming Sunday, August 17th at 7 p.m. Eastern time, I'm hosting a free live Zoom call to detail something for you I call the asymmetric trade. This is a special type of trading strategy that can help you profit regardless of whether the market is going up or going down. In fact, over the past year and a half, I've used this strategy myself to take home returns as high as 297%, 733%, and even 1,354%. And even though massive 1,000% plus gains are the exception, they are not the rule. I want to show you why I think the next few months could hand out some of the biggest asymmetric returns we've seen yet. If you're interested, all you have to do is click on the link in the description below to register for the event and show up on Sunday, August 17th at 7 p.m. Eastern time. Like I said, attendance is completely free, but the Zoom spots are limited, so don't wait. Look forward to seeing you there. If you're wondering why this debt accumulation, the spending, the deficits, the borrowing is not slowing down, it's because it can't without triggering a deflationary death spiral. And policymakers understand this because every dollar that comes into existence through a loan. Dollars are loaned into existence. They're not printed. Even in circumstances where the Federal Reserve creates dollars, they're doing that through debt. When banks create dollars, they're doing that through debt, which means that every new dollar added to the total dollar supply equals more than $1 in future dollar demand. Because at some point, that person or entity needs to pay that dollar back plus interest, and they have to get those dollars from somewhere. Which means if the dollar supply is not continually increased, then as the debt starts to get paid back, it starts to decrease the total dollar supply, making it harder to get your hands on dollars, making dollars more valuable relative to everything else, causing prices to plummet as a mad scramble for dollars begins, and the realization that there are very few dollars compared to all the debt that needs to get paid back. In other words, you get something like the Great Depression, but maybe even worse. This is why people like Milton Friedman say that inflation is always and everywhere a monetary phenomenon. It wasn't that he was saying you can't get price increases without the Federal Reserve. He was saying, hey, in the Great Depression, if you wanted to stop deflation from happening, all you would have had to do was print money to the extent that was necessary. Now, if you know me, you know that I don't think that that is a healthy solution or a solution that will be good for anyone. But it is true that policymakers understand that unless you continue inflating the dollar supply, it will cause a deflationary collapse. And they won't let that happen because they're the ones who benefit by keeping the game going, which means we are entering into a great wealth transfer. It has already started, but it will continue for a long time. This is a wealth transfer from savers to borrowers and from earners to owners. The reason why it's wealth transfer from savers is because savers are lenders. You cannot save without simultaneously lending unless you have physical paper dollars that you keep under your mattress. If your money is in a bank account, a brokerage account, a 401k, or a money market, it's being lent out. And virtually every savings and lending vehicle that your money goes into today is providing you a return that is less than the real rate of inflation, which means that as much as you save, you are losing purchasing power and it's being transferred to the borrowers. Big reminder that the biggest borrowers are the ones who are in control of the direction of this wealth transfer. Now, the borrowers are also benefiting here because of the purchase of assets. Inflation simultaneously makes debt easier to pay off and makes your assets worth more. So why is this also a wealth transfer from earners to owners? Well, it's a wealth transfer away from earners because earners only make more money once their cost of living has already gone up. You're going to get your raise based off the inflation rate after the inflation has already happened, which means you're not getting compensated for everything that you've already had to be paying. And it's wealth transfer to owners because owners own assets. Those prices of those assets go up, which means that people like me and hopefully people like you don't really have to care too much if the cost of living goes up. If the cost of milk or eggs or meat goes up at the grocery store, it's not really going to affect my life that much. In fact, positioning yourself well means you actually benefit even more because the more inflation there is, the richer you get, and it more than compensates you for the cost of living increases along the way. This is not something that is slowing down anytime soon. Like I showed you earlier, this trend is accelerating. Just government borrowing alone is increasing every year to the point where the borrowing that they did during 2020 and 2021 will soon look like child's play. This is a direct devaluation of the dollar, and if you are not prepared, you're not on the winning side of the fence of this, please join me this coming Sunday to my asymmetric trading masterclass and share with you everything I know. Link is below. As always, thank you so much for watching. Have a great day.